Temporary drawdowns in a diversified portfolio of liquid assets are not only normal, but actually healthy. You get a good return in the medium and long term because you're compensated for the risk that you accept in the short run.
Now, this is a topic of conversation. I'm pretty sure that, most investors and clients really care about performance, but rightly so. Performance is key.
Absolutely. The problem is to analyze and assess performance with the adequate angle and tools.
Okay, so is it just about always getting the best performance from your investments? And how much of it is just simply avoiding bad performance?
The key is to avoid permanent losses. Temporary drawdowns in a diversified portfolio of liquid assets are not only normal, but actually healthy. You get a good return in the medium and long term because you're compensated for the risk that you accept in the short run. So volatility is perfectly normal within certain boundaries. The second aspect that is often very poorly understood is that for most investors, and in particular in liquid market, this is all about relative performance. Some people believe they are in an absolute performance game. Some are. It's called hedge fund, alternative investment. It carries much higher fees, 2 and 20 if you're lucky, because those who truly produce non-market dependent returns that are in this absolute performance game, they actually often charge more than 2 and 20%
What do you mean? What do you mean 2 and 20%?
2% fixed and 20% of performance.
Okay.
Some charge 3 and 30 or more. And by the way, most of them do that in a capacity constrained manner, therefore are most often close to new investor rather than available. So it's a completely different game. For everyone else, investing is a relative performance game in the short term, and it will be an absolute performance game in the medium and long term by the time the strategy that you follow will produce the intended consequences, positive performance.
How do you measure performance then as a CIO, and how should clients measure performance?
Yeah, so we measure it on a relative basis, relative to our benchmark in asset allocation and within the building blocks of our portfolio. And we also measure the performance on a relative basis versus our direct competitor and peers.
Do you worry about performance? Because really, isn't performance the hallmark of a skilled manager?
Oh, absolutely. The problem is we're acting on a fiduciary basis. We manage money on behalf of other people. And of course, you have a commercial risk in that activity. The risk of being fired as a manager and losing the business, right? And this carry risk in its most extreme form is something that is present in every investment manager, professional investment manager's mind. So there are things you can do when you manage your own money, which are more difficult to do when you manage money for other people. Let me give you an example. A few of the most successful legend hedge fund manager of the last 2 or 3 decades made a decision last decade to return third-party assets, external investors' money to investor, and move to a purely internal family office type investment organization.
So just managing their own?
Just managing their own money. Same manager, same experience, same skill set. The performance outcome is day and night. This obsession about managing the short term, avoiding drawdown, that is very, very acute in the hedge fund industry, because supposedly you're in the risk mitigation, absolute performance game, right? Completely kills return. The moment their risk-taking capacity is disinhibited because it's their own money and they bear the responsibility and the consequences of what they do, and they don't have to explain every month or every quarter why the market went up or down and why they are up more or less than the market, immediately performance improves. And the point I'm getting at is you cannot judge the performance of even those investors with the greatest track record in the short term. The best manager can look spectacularly stupid in the short term and be massively right in the long term.